Well, as we get ready to start the trading session on a big day here at the stock exchange with two companies set to debut and mark their first trades, I do want to bring in our resident expert, Jay Woods. He's a chief global strategist at Freedom Capital Markets. Jay, always good to see you, especially on a double IPO day. We see the signage behind us, and Hinge Health is going to kick things off soon. What does this mean for markets?
Well, it's exciting. As someone that used to be a market maker for most of my career, I'm jonesing to get back down there and trade because price discovery is something we take very seriously here at the NYSE. So this process is exciting for the two companies going public today. They've reached a milestone. They're handing the baton off to their market maker, and now the public gets to invest in these companies they've heard so much about. So for me, it's exciting. There's a buzz in the building, and I wish I was part of it, but I get to talk to you, which isn't a bad
You
bad
are part of it on NYSE TV Live.
I'm bumping Ryan Reynolds, apparently. I'll leave if you want to get him in here, but it's exciting. It's an exciting day.
It definitely is indeed, and just how meteoric the rise from those lows has been really in this recovery. How much of that helps an IPO market?
Well, it definitely does. When the IPO market has been slow, no one's going to deny that. We've been waiting for quote-unquote market conditions to improve. We came into the year at all-time highs. We were hopeful that first quarter, second quarter, we'd start to see more big names go public. It's starting to happen. This is a great day. 2 in 1 day, you don't see too often. So let's hope these go well and the economy, continues to chug along slowly but surely. I think this sets us up for a great second half of the year on the IPO front and overall for this bull market to continue.
Okay, let's talk about some news this morning. The budget bill passing the House. Now it makes its way to the Senate. This does push through President Donald Trump's agenda, specifically when it comes to extending those tax cuts. How is the market receiving that?
Yeah, the market is right now. We had a couple of things. The market's looking at this. This is not going to help reduce the debt, and that's kind of what Moody's told us on Monday they were fearful of. So when we got the downgrading from 3A to AA1 to put them in line with the other two rating agencies, we kind of shrugged that off. This now passes by one vote, 215 to 214. We'll see how it goes through the Senate, what changes come to it, but right now it doesn't have investors overly excited. We're still worried about the long-term ramifications. We saw that in the 20-year auction, something we don't pay attention to down here. My 30 years, no one's been like, why are we selling? Oh, the 20-year auction. But they had trouble finding buyers for that, which meant yields are going to rise, and it's trickling through the bond market, which then led equities to sell off. So we've had a nice relief rally. We're digesting those gains, but these little headlines get people skittish because we still remember where we were just April 7th, a month ago.
That's right. And on my way up to studio here, another trader on the floor did inform me that there is another auction this afternoon. So it's certainly something that I think investors will be watching closely. We are toward the tail end of earnings season. The end of the first half will be here before we know it. What are the fundamentals in place that could set us up for a strong second half, as you mentioned earlier?
Well, the fundamentals that are good in the sense that companies are beating the earnings. The guides have been all over the place because of that quote-unquote uncertainty in the market. None more than what we saw with the retail guides over the last week. It started with Walmart last week, where they said they may have to raise prices because of tariffs. The president fired back aggressively with a tweet over the weekend, and now TJX, Target, BJ's, they're all coming out with okay earnings, but they are very careful how they say, we're not going to raise prices, we're not going to pass it on to the consumer. Nike today is up 2%. They have a deal back with Amazon to be online, which is great, but they're also raising prices. They did not say tariffs are the reason why. So when people are passing that cost on to the consumer, they're very wary of upsetting the apple cart in Washington and saying tariffs are the reason. So it's interesting to see how we go, but then you look at a stock like Snowflake, tech is still beating and they're still having solid guidance. So all eyes are on one stock next week, and that's NVIDIA. We'll see what they do. Stocks had a tremendous rally back. Ken Jensen, give us something on a guide that makes us take a leg higher, and then we'll be talking new highs in the S&P 500. I think that's a stretch, but we are poised, if they deliver, to continue this rally a little longer. I
think just about 5% from a record high that we saw last in February, right?
Exactly. We got to 3%, and then we pulled back a little bit. But healthy, we're above the 200-day moving average. We're above 5,800, which was that gap up above the 200-day and post-election day. These are healthy signs, but for those thinking V-shaped recovery to new highs, I think that's an aggressive thought. I think we need to consolidate a little farther, maybe retest the 200 and the 50-day, go back to 57.75. That is not far from here. These are normal levels.
Yeah.
So if we retrace back to the 50-day, which is 55.75, I'm still okay that we consolidate as long as the guides are solid, the earnings continue to beat that lower bar, and we get through the tariff negotiations, which are now extended to June, July, and we get through this tax bill. Then we get some clarity, and maybe, just maybe, we finally get that leg higher with solid earnings in the third quarter.
Yeah, and has any of this changed your outlook on rates, Jay? I know we spoke just a few days ago, but there really are a range of expectations as to how the Fed responds in this environment.
The Fed has changed their tune. They always focus on hard data, one data point at a time, and they telegraph their moves. Now they're saying, well, the hard data is great. Inflation seems to be under control. Unemployment's still at historical lows, but they're concerned. So they're going into the sentiment camp, which is at historical lows, and they're waiting to see what happens in Washington. But if they were to look at the numbers, look at the policy, they could cut a quarter of a point. That's kind of how they set us up in December. So we'll see what happens at that June meeting. We still have the PCE coming out and a lot of key little points before their next meeting. And of course, Fed speak all the time. So we'll see what they say. But right now, the Fed is just kind of feeling like they're at that Goldilocks moment where they don't have to do anything, and they're afraid if they cut, something can change in the data that makes them look foolish. So they wait and they wait and they see, and we'll see what they do. So I think they can cut a quarter point. I don't think they will.
All right, well, good day here at the Stock Exchange. We got a lot ahead, of course, with 2 IPOs kicking off. And Jay Woods, Chief Global Strategist at Freedom Capital Markets, starting with us here on set. Jay, thank you.